And our featured guest is John O'Donohue, head of equities at Cowen Co. John, let's start with you. You know, market's taking a little bit of a breather today, but not too much of one after yesterday's rally. Not surprising to see this trade.
Hey, Carol. No, I think what's happened is we've gotten into this towards the end of the year trade where I think people are somewhat defensive in keeping their gains, and you're not going to see an awful lot of activity, I think, to either the upside or the downside. You know, the upside may be capped up a little bit by 1125 in the S&Ps, which is actually a full 50% retracement from the highs that we had back in '07 to the lows that we had in March of this year. But, you know, to the downside, I don't think there's an enormous amount of fear out there. We've got the Fed kind of steady as she goes, and there's still quite a bit of cash around on the sidelines.
John, do you think that we're going to see then a big pickup in January? I mean, Jeremy Siegel came on the show earlier, and he said, you know, some people are taking profits off the table right now, but in January they'll come back in because they've made so much this year.
I think that could be the case. I mean, I think the one thing I was curious at before I came down here was the divergence that we're starting to see in the S&P 500 versus the Russell 2000, where the Russell is down about 5–6% now versus the highs it made in October, and the S&P is banging here towards new highs, which tells me that money going into equities is going into the bigger, safer stocks, and particularly those that have dollar exposure. If you look at what's making new highs today, such as Coke and Pepsi and McDonald's and Procter and those kind of names, those are big, safe, liquid names that have global exposure. So people feel a lot more comfortable in those names.
I want to get your take on this, John. You know, we've seen so many government stimulus programs, even on top of the $787 billion main bill here. We continue to see extensions for unemployment, extension for the first-time home buyer credit, and that broadened out as well. Do these things continue to encourage stock investors, or is there an inflection point where you say, hey, this is getting to be too much, and you turn around?
Well, I think you have to ask the question, when do they take the punch bowl away? You know, one of the big issues is how do you pay for all of this, and obviously it's the selling of the sovereign debt. And you know, what we've seen in the last few days, the 2-year, 5-year auction went very well, and obviously that's still, despite all the jawboning that came out of China during President Obama's visit, is there are buyers around for U.S. sovereign debt. The one thing I'll point out to you, which is a bit of an underlying effect, though, is the CDS market in sovereign debt has started to dislocate here in the last few weeks, which is more of a bet on the future, which would tell you that at some stage rates are going to have to go higher to attract people in to buy the debt. That's how we pay for all of this stuff. So
at this point, though, there's no shortage of buyers, right, John? I mean, with rates here, you can continue to print money. Exactly.
You know, I wrote you that in a note. I said, you know, a lot of people are questioning when does this end, and I'm not so sure when it does end, because it just seems like there's quite an amount of demand out there, which I think is quite surprising to some of the experts.
So, John, let me ask you, I mean, over the next couple of days, retail, the consumer really become back in focus again because of the holiday sales that we're going to kind of see how this plays out?
Sure. I mean, if you look at what happened even today with Dollar Tree, which announced their numbers, you know, it looks like this trade that we saw at the back end of '08, which was into the discounters and out of the big department stores and some of the specialties, is taking place again. So you've got Walmart, Dollar Tree, Family Dollar was on the move again today. And then if you look at some of the names that have rolled over a little bit, whether the teen stocks like Urban Outfitters and Aeropostale, there's definitely a different trend that we've seen. Tiffany reports tonight, so that'll be an interesting number. That will probably be held up by its dollar exposure. So that you know, that and Coach, I think, are two names that probably stand out on the upper end that seem to be doing just fine. But yeah, it's going to be a very differentiated holiday season as we get into Black Friday.
So, John, in terms of a bubble, what is it? Is it the commodities bubble? We just kind of talked about this a little bit, or China or Treasuries? What do you think?
Well, I think it depends on what level you look at. I think what we've had is a dollar which is driven a lot of commodity pricing, which is in dollars, obviously higher because of the weakness in the dollar. If you think about the demand, the actual demand for some commodities, yes, China could be the culprit, if you will, vis-a-vis pricing. You know, you want to look at oil a little bit there too, but that's also an effect of the weaker dollar. So it's a lot more from a macro perspective. It's the domino effect, if you will, that's caused by a very, very aggressive stimulus package, which means interest rates stay low. And as interest rates stay low, it affects the sovereign debt, and obviously it affects the dollar. So hence, those that are priced in dollars are going to move a lot higher. So yes, if you want to call it a bubble, it is, but it's caused by a lot of cause and effect.
Does that make it less destructive?
No, not at all. Not at all, because there's a thing we call on Wall Street, which is regression to the mean, and over time, things will regress to the mean. So you'll see that happen over time.